You've seen this 100 times. A grandparent wants to help out, so they pay for their grandchild's college tuition. It's an amazing gift, right? But what seems like a simple act of kindness can actually create a massive tax headache, potentially costing a family thousands of dollars. So today, we're going to do a deep dive into the very specific, kind of quirky tax rule that solves this whole problem, what we call the AOTC Grandparent rule, and exactly how you can use it to your client's advantage.
Okay, so let's just start with this classic real-world scenario. You have a generous grandparent who writes a check for tuition, sends it straight to the university. So who gets to claim the tax credit for that payment? Is it the grandparent who actually paid, the student whose tuition was paid, or the student's parents, who are probably claiming them as a dependent? Well, as we're about to see, the answer is not at all obvious, and it all comes down to a really clever piece of tax law. All right, here's our roadmap for today. First, we'll get into the weeds of the core issue, what I'm calling the payer problem. Then, we'll unpack the pretty elegant solution the IRS came up with, the grandparent rule. After that, we'll see how this whole thing interacts with gift tax, which is fascinating. Then, of course, we'll cover the critical tax traps you have to avoid. And finally, we'll bring it all home with some strategic planning.
So, Section 1. At its heart, this entire issue really just boils down to a fundamental rule in tax law. The person who gets a tax benefit, like a credit, has to be the same person who actually paid the expense. The second someone else pays that bill, the system kind of breaks down.
Now, the benefit we're talking about here is the American Opportunity Tax Credit, or the AOTC. You'll find it in Internal Revenue Code Section 25A, and it is, without a doubt, the most valuable federal tax break for higher ed. We're talking a dollar-for-dollar credit of up to $2,500 per student, which, as you know, makes it an incredibly powerful tool for families.
The whole problem really just comes down to this one simple phrase in the tax code: the expense must be paid by the taxpayer. And, the law is super strict about this. If you take it literally, it means that if a grandparent pays the tuition, the parents, who didn't technically pay anything, cannot claim the credit. The family would lose out on a $2,500 credit just because of who signed the check. It's a real problem.
So it seems like we've hit a wall, right? Well, not quite. And that brings us to the really elegant solution that the Treasury Department came up with. In Section 2, we're going to explain this grandparent rule by unpacking the very clever legal fiction it creates.
Okay, the magic really happens in Treasury Regulation Section 1.25A-5B. This rule creates what we in the tax world call a legal fiction. And the most important phrase on this slide is solely for purposes of Section 25A. That's the saving clause. It basically allows the IRS to pretend a transaction happened differently than it did in the real world, but only for calculating this one specific credit. And this quote shows you exactly how that legal fiction works. The regulation says the student is treated as receiving the payment from, say, the grandparent, and then, in turn, is treated as paying the school themselves. Now, we all know that's not what happened. In reality, the money went straight from grandma's bank account to the university. The student never saw a dime. But for tax purposes, the law literally invents this two-step phantom transaction.
So this is the crucial part, this two-step deemed process. Step 1, we have the deemed gift. The grandparent's payment to the school is treated as if they just gifted that cash directly to the student. Then, Step 2, the deemed payment. The student is then treated as if they took that imaginary cash and paid their own tuition. This is the legal mechanism that gets the payment attributed to the student.
But wait, it gets even more clever, because it's not just one regulation, it's two working in tandem. First, you have Regulation 1.25A-5B, our grandparent rule, which deems the payment as going from the grandparent to the student. Then, a second rule, 1.25A-5A, kicks in. It says if that student is a dependent, any expenses they are deemed to have paid are also deemed to have been paid by their parents. You see what happens? The payment legally travels from the grandparent through the student and lands with the parents, who can now finally claim the AOTC. It's brilliant.
Now, this income tax fiction creates a really fascinating situation when it bumps up against a totally separate area of the tax code. So let's look at Section 3, gift tax versus income tax, and how this one single payment is treated under two completely different sets of rules.
This is where we get into some high net worth estate planning. Internal Revenue Code Section 2503E gives us the qualified transfer rule, and the key word here, the one that matters, is unlimited. This rule provides a complete, total, unlimited exclusion from federal gift tax for any tuition payments made directly to a school. a grandparent could pay a $70,000 tuition bill, and for gift tax purposes, it's like that transfer never even happened.
And to really get how powerful that is, just compare it to the normal annual gift tax exclusion, which is sitting at $19,000 for 2025 and 2026. Any gift above that to one person in a year starts eating into your lifetime exemption. But because of Section 2503E, a grandparent can pay a massive tuition bill and still give that same grandkid a separate $19,000 gift, all with zero tax consequences.
This slide just captures it perfectly. You've got this theoretical tension that's resolved so elegantly. For income tax, the payment is deemed a gift to the student. That's what we need for the parents to claim the AOTC. But for gift tax purposes, a completely different section of the code says that exact same payment is explicitly not a taxable gift. So the transaction is whatever it needs to be depending on which tax you're calculating. It's a perfect win-win.
And the benefits just keep coming. We also have to think about the generation skipping transfer tax, the GSTT. Well, IRC Section 2611B1 specifically says that any transfer that's exempt under that 2503E tuition rule is also exempt from the GSTT. And what's really crucial here is that the income tax fiction we create for the AOTC doesn't mess with this powerful protection. So you get a trifecta of tax benefits.
Okay, this all sounds pretty fantastic, but these legal fictions have very, very specific boundaries. It is incredibly easy to make a costly mistake. So let's pivot to Section 4 and talk about navigating the common tax traps, where all these different rules just don't play nicely together.
This brings us to probably one of the most common questions we get from both advisors and taxpayers. Can you use a tax-free distribution from a grandparent-owned 529 plan to pay tuition and then also have the parents claim the AOTC for those exact same expenses?
The answer to that is a very clear, very loud no. And it's all thanks to what's known as the anti-double dipping rule. You'll find it in Internal Revenue Code Section 25A-G2, and its whole purpose is to stop taxpayers from getting two different tax breaks for the same dollar of education expenses.
So here's how it works, mechanically. To claim the AOTC, you need what are called Adjusted Qualified Education Expenses, or AQEE. The law says you have to take your total expenses and reduce them by any tax-free help you got. And wouldn't you know it, the tax-free earnings part of a 529 distribution counts as tax-free help. So, if a tax-free 529 distribution pays for the first $4,000 of tuition, your AQE for the AOTC drops all the way to zero. And if you have no expenses, well, you get no credit.
And there are a couple of other really critical traps to watch out for. First, the support test. Remember that deemed gift to the student? Well, that little legal fiction is only for the AOTC. Under IRC Section 152, that tuition payment still counts as support provided by the grandparent for dependency tests. Second, and this one is brutal, is credit recapture. Regulation 1.25A-5 says that if the student gets a tuition refund, the tax liability for that credit falls squarely on the parent who claimed it, even if the university mails the refund check back to the grandparent. Think about that. The parent owes the IRS while the grandparent gets the cash back. Ouch.
Okay, that's enough of the doom and gloom. Let's talk about how to actually use these rules to your client's advantage. In our final section, let's focus on strategic planning and putting these complex rules to work.
The classic use case here is so simple and effective. You have high-income grandparents who are phased out of the AOTC. They pay the tuition directly for their grandchild, whose parents have moderate income and are fully eligible. It's perfect synergy. The grandparents get money out of their estate tax-free, and the family as a whole captures a $2,500 credit that would have just vanished otherwise. But the absolute key here, and I can't stress this enough, is meticulous documentation. Keep copies of the check, the university bill, and even create a little memo citing the regulation just in case you ever have to defend the position in an audit.
In this table right here, this is really the ultimate takeaway. It's a practical guide for analyzing the different funding options. You can see right at the top, direct cash payment from a grandparent to the school is the absolute gold standard. The parents get the AOTC, and the transfer is totally exempt from gift tax. Now, giving cash to the student first still works for the AOTC, but you might create a gift tax issue. Using a tax-free 529, that wipes out the AOTC completely. And making a taxable distribution from a 529 can work, but then someone's got to pay income tax on the earnings. This is the decision matrix you need.
So we'll just leave you with this final thought. Now that you've seen how this powerful legal fiction actually works, this deliberate separation of what really happened from what the tax code says happened for one very specific purpose, how might this change the way you approach structuring those intergenerational wealth transfers and education funding plans for your clients? It is a perfect example of how getting deep into the technical rules can unlock some really significant value.